Let's look at this next question. If a company issues bonds with a face value of Rupee 1000, a coupon rate of 8% PA, and the prevailing market interest rates increase to 10%, what is likely to happen to the bond's price? Here are your options. A. The bond price will increase. B. The bond price will decrease. C. The bond price will remain the same. Or D. The bond will become risk-free. Take a moment to pause the video and decide. The correct answer is option B. Let's see why. When market interest rates rise, existing bond prices fall to align their yields with new bond issues. An investor wants a steady return with minimal risk and is willing to accept lower returns. Which type of security is most suitable? Here are your options. A. Equity shares. B. Derivatives. C. Debt instruments. Or D. Convertible bonds. Take a moment to pause the video and decide. The correct answer is option C. Let's see why. Debt instruments provide fixed interest income and lower risk compared to equity. Let's look at this next question. A company issues shares with a face value of Rupee 10 at a market price of Rupee 50. It declares a 40% dividend. How much will an investor earn per share? Here are your options. A. Rupee 4. B. Rupee 20. C. Rupee 50. Or D. Rupee 40. Take a moment to pause the video and decide. The correct answer is option A. Let's see why. Dividend is calculated on face value, not market value. 40% of Rupee 10 equals Rupee 4. Let's tackle this exam question. An investor purchases a stock trading at a PE ratio of 20x. If the company's earnings per share, EPS, is Rupee 5, what is the stock price? Here are your options. A. Rupee 100. B. Rupee 50. C. Rupee 25. Or D. Rupee 10. Take a moment to pause the video and decide. The correct answer is option A. Let's see why. PE ratio equals market price divided by EPS. Right pointing arrow. Market price equals 20 times Rupee 5 equals Rupee 100. Let's tackle this exam question. Which of the following is true for market capitalization? Here are your options. A. It represents the total equity value of a company. B. It is calculated as market price per share multiplied by outstanding shares. C. It changes with stock price fluctuations. Or D. All of the above. Take a moment to pause the video and decide. The correct answer is option D. Let's see why. Market cap depends on stock price and number of shares, representing total equity value. Test your knowledge with this one. Which statement about enterprise value, EV, is correct? Here are your options. A. EV only includes market capitalization. B. EV equals market cap plus total debt, cash and cash equivalents. C. EV is always equal to book value. Or D. EV only applies to government securities. Take a moment to pause the video and decide. The correct answer is option B. Let's see why. Enterprise value accounts for both equity and debt while subtracting cash. A company issues DVR, Differential Voting Rights, shares. How are these different from regular shares? Here are your options. A. They provide higher dividend but limited voting rights. B. They provide additional voting rights per share. C. They offer no dividend benefits but more voting power. Or D. They are illegal in India. Take a moment to pause the video and decide. The correct answer is option A. Let's see why. DVR shares allow companies to raise funds while limiting dilution of voting power. Moving on to the next one. If a stock has a PBV ratio of 0.7, what does it indicate? Here are your options. A. The stock is overvalued. B. The stock is undervalued. C. The stock is priced at its book value. Or D. The stock is trading at a high PE ratio. Take a moment to pause the video and decide. The correct answer is option B. Let's see why. A P by BV ratio less than 1 suggests the stock is undervalued. Moving on to the next one. A bond that pays no interest but is issued at a discount is called. Here are your options. A. Floating rate bond. B. Convertible bond. C. Zero coupon bond. Or D. Callable bond. Take a moment to pause the video and decide. The correct answer is option C. Let's see why. Zero coupon bonds are issued at a discount and redeemed at face value. Let's tackle this exam question. The price of a bond is most sensitive to changes in. Here are your options. A. Interest rates. B. Dividend yield. C. Company revenue. Or D. Earnings per share. Take a moment to pause the video and decide. The correct answer is option A. Let's see why. Bond prices and interest rates have an inverse relationship. Let's look at this next question. If a company borrows in USD instead of INR, what additional risk does it face? Here are your options. A. Market risk. B. Liquidity risk. C. Foreign exchange risk. Or D. Regulatory risk. Take a moment to pause the video and decide. The correct answer is option C. Let's see why. If the INR depreciates, the company needs more INR to repay its USD debt. Moving on to the next one. Which type of bond allows the issuer to buy back the bond before maturity? Here are your options. A. Perpetual bond. B. Callable bond. C. Convertible bond. Or D. Zero coupon bond. Take a moment to pause the video and decide. The correct answer is option B. Let's see why. Callable bonds give issuers the right to redeem bonds early. What is a key characteristic of a perpetual bond? Here are your options. A. It has a fixed maturity date. B. It pays dividends instead of interest. C. It has no maturity date. Or D. It has no credit risk. Take a moment to pause the video and decide. The correct answer is option C. Let's see why. Perpetual bonds continue indefinitely unless called by the issuer. Test your knowledge with this one. An investor buys a bond with a coupon rate of 6% and a YTM of 8%. What can be inferred about the bond's market price? Here are your options. A. The bond is trading at a discount. B. The bond is trading at par. C. The bond is trading at a premium. Or D. The bond is risk-free. Take a moment to pause the video and decide. The correct answer is option A. Let's see why. When YTM equals coupon rate, the bond trades at a discount. Here is another practice question. In a high inflation scenario, which bond provides protection against inflation? Here are your options. A. Convertible bond. B. Perpetual bond. C. Inflation-protected security. Or D. Callable bond. Take a moment to pause the video and decide. The correct answer is option C. Let's see why. Inflation-protected bonds adjust their principal or interest payments to inflation. Here is another practice question. The intrinsic value of a stock is. Here are your options. A. Always equal to its market price. B. The estimated value based on future earnings. C. The total assets of a company. Or D. Its face value. Take a moment to pause the video and decide. The correct answer is option B. Let's see why. Intrinsic value is based on discounted future earnings of a company. Let's tackle this exam question. A company issues a bond with a floating interest rate. What is the main advantage for the investor? Here are your options. A. Fixed and guaranteed returns. B. No default risk. C. Higher risk than equity investments. Or D. Protection against interest rate fluctuations. Take a moment to pause the video and decide. The correct answer is option D. Let's see why. Floating rate bonds adjust their interest rates to market conditions. Let's look at this next question. If an investor holds a bond for a specific period and sells it at a profit, the return earned is known as. Here are your options. A. Dividend yield. B. Holding period return, HPR. C. Yield to maturity, YTM. Or D. Face value. Take a moment to pause the video and decide. The correct answer is option B. Let's see why. HPR measures returns based on actual holding period, including interest and capital gains. Let's tackle this exam question. Which of the following statements is correct about market price versus intrinsic value? Here are your options. A. Market price is driven by speculation, while intrinsic value is based on fundamentals. B. Market price is always higher than intrinsic value. C. Market price and intrinsic value always remain equal. Or D. Intrinsic value depends only on past earnings. Take a moment to pause the video and decide. The correct answer is option A. Let's see why. Market price fluctuates due to speculation, while intrinsic value is based on company fundamentals. Test your knowledge with this one. If the market PE ratio of an index increases significantly, what does it indicate? Here are your options. A. Stocks are likely undervalued. B. Stocks are likely overvalued. C. Earnings are increasing rapidly. Or D. Interest rates are falling. Take a moment to pause the video and decide. The correct answer is option B. Let's see why. A high PE suggests investors are paying more for earnings, possibly indicating overvaluation.